Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that really don't make any sense. And after all, if they made sense, why would you waste your time watching me? Well, we're going to demystify a little bit of what's going on, and then we're going to get right into your questions. Got a whole bunch of good ones for tonight. The first thing is, oh my God, is this a market bottom? No. So why are stocks going up? Is it because of a stimulus bill or no? Here's why. At the end of every quarter, so you're about a week going into the end of a quarter, money managers such as pension funds and institutional money managers have to rebalance their portfolios. And you say, well, what are you talking about? Well, asset allocation is a type of investment management where you have a certain percentage in stocks and a certain percentage in bonds. And you tell your clients, look, you're going to have 60% of your portfolio in stocks and 40% of portfolio in bonds, for example, which is the most common one out there. Now, about every quarter, this has to get rebalanced. So what's happened this last quarter? Stocks have gone down in value and bonds have gone up. So if your 60-40 portfolio is now 50-50, that investment manager has to buy stocks and sell bonds. There's a reason I don't really care for asset allocation portfolios. There's a couple people out there that do a great job of it. But the things you're going to see with pension funds, which are typically 60-40 blends, institutional money managers, the things you're seeing in your 401ks, your IRAs, the non-managed stuff that you think is great, I really don't like. They're also in variable annuity products and things like that where there is an asset allocation model. Not a big fan of them, because what's happening right now is we are in a bear market. When you're in a bear market, you do get bounces like this. But why is this happening? Because they're forced to buy stocks and sell bonds. Yet in a bear market, you want to buy bonds and sell stocks. The trend is your friend. You want to buy what's rising and sell what's falling. But in an asset allocation model, you end up doing the exact opposite. And this is one of the reasons why, when the bear market's over and the recession ends, investors will pull up their statements and go like, how did I lose that much money in a diversified model? It's because you don't realize every quarter you're getting forcibly rebalanced. Some, not a lot, do it every month. Robo advisors, which I am not a fan of, because what you don't know is they rebalance daily. So you're being constantly rebalanced on the way down, buying stocks as the market is falling. So I think it's like I said, a poor way to manage money. It is the most common investment strategy on the planet, and that's why in the final week of the year you can get these, or final week of the quarter, you can get these outsized moves as money managers make the adjustments. Now on top of that, you have retail investors going, oh my God, the bottom's in, I better jump in. Major market bottoms always have at least two tests of the bottom. So if this was, in my opinion it's not, but if it was, there will be a second attempt at it. So you don't have to worry if you missed it. So looking at what's going on in the markets, this is what I think where we're at. You have this, hey, remember new paradigm, stocks go up forever no matter what. And then it went down and people are like, there's no way that can happen. And you get in what's called this bull trap where all of a sudden there's this feeling that, the coronavirus is going to go away. Everybody's going to be going back to work. Everything's going to be okay. And look, markets have gone up. So the return to normal. And then the reality sets in and away it goes. So I think we're somewhere in here right now. And that is being boosted by asset allocation models forcibly having to rebalance. So I hope that helps you out a little bit, gives you a little taste of why I don't like them. And maybe you do, but that's just kind of my opinion on why I'm not a big fan of them. Again, there's a couple people out there that do a great job, but your mainstream asset allocation models, in my opinion, I give a big thumbs down to. Okay, where do we want to go next? Your questions. Yes, and we have some good ones. And I appreciate everyone sending it in. I hope you're getting a great amount of value out of them. Again, your questions, not my questions, your answers. Your questions, my answers. Number one, and I'm going to kind of read these off the screen, is if the world's dollar liquidity is at record lows, then is their only recourse is to sell off Treasury? So the question is kind of referring to foreign central banks in gold in their possession to raise dollars. So how much Treasuries do foreign markets hold? And would they be sellers in large volume fairly soon? That is a great question. Let me show you where you can find that data. This is the now I got to see it. This is the tick data. So you can go to tickdata.treasury.gov/publish/mfh.txt. It's updated monthly. It's a little behind, but that's just the nature of it. And you can see major foreign holders of Treasury securities. And what you'll notice down here is the grand total, and its range of between 6.3 to 6.8 trillion, with the number of Treasuries going up between December and January. What you can glean off this report is it's pretty static. There's not a lot of change going on here. So you say, well, why isn't there selling of this going on? That's a great question. And the answer is simple. The way world dollar liquidity works is the global economy will contract down to the amount of dollars, and then it'll try to run. And if as long as that holds, then the economy will eventually settle down to that point. If dollars continue to evaporate, the economy will continue to shrink down until it's got the right amount of dollars. Think of it, if our height was relative to how much blood we had in our body, and someone who has a lot of blood might be 8 feet tall, and someone who didn't would be 3 feet tall. And if you could take a syringe or something and pump blood into someone who's 3 feet tall, you could make them taller by putting more blood in them. And that's kind of how the monetary system works. Now, obviously, our bodies don't work that way, but that's how the monetary system works. It expands as it has more dollars and contracts down to the number of dollars there. So the question going into is, would they be sellers in fairly large volume soon? No, because what's happening is the global economy is trying to balance at the level of dollars available. Going on to the next question, which is a continuation of the first one, but liquidity can't get into foreign hands without U.S. consumers buying foreign goods, correct? Wouldn't the only option left for foreign central banks to liquefy U.S. treasuries in gold? No, because there still is a continuation of things being bought. It's just not being bought at the same level. It's not like it went from 100% to zero. There's still commerce occurring there. Whoops, I meant to hit Alt Tab so I can get back to the question. So what you'd expect is slowing spending will lead to a contraction in the global economy. And this is where you can go back to, say, President Trump recently saying that the U.S. economy, and I am messing around up here, is having trouble or needs to get back to work soon, because effectively what he should say is a debt-based global economy does not work when the largest consumers in the world are not consuming. That's what he should have said. Now, maybe it's what he meant. Maybe he didn't understand what he was saying, but he knew the U.S. economy does not work with Americans at home, and the global economy doesn't either. So what will happen is global economy will continue to contract down to the amount of dollars in the system. All right, next set of questions. I asked where the Fed gets their money to buy infinite bonds, and you said they conjure it out of thin air. That is correct. It's just a computer entry. Imagine opening up a spreadsheet and typing in $1 trillion. That's literally exactly what they do. Are those Fed IOUs? I'm not familiar with the term Fed IOUs, so I'll say no, that it is not. If that's the case, commercial banks don't get real cash when they sell their bonds. That's not true. They do get real cash. It's a computer entry, but it's as real as fiat currency can get. Let's see. Which they can only use as a reserve to give loans. That is correct. So the Fed is not printing money. So this is where it gets weird. The Fed is not printing money because it's not going directly out in the hands. It's getting locked up in reserves at banks, and that's how they protect themselves from printing money. Again, then banks are the only people that can create money through lending. That's how the system works. Now, if the Fed could directly send us checks, which they can't do, and don't worry, whatever the stimulus bill is going to be, which is not really stimulus, but whatever it is going to be, it's going to come from the U.S. Treasury, so from the taxing authority, not from the Federal Reserve. Let's see. So going on here. So the Fed is not printing money. That's correct. The Fed does not have the legal authority to print money. They're printing IOUs. No, they're actually just swapping cash for U.S. Treasury bonds is what they're actually doing. Which the commercial banks use a reserve for loans. Yes. If the banks don't issue loans, no money is created. That is absolutely correct. Banks are the only institution in this country that can create money. The Fed is just swapping, okay? Think of it as maybe I need a car and you need some money and I'm going to loan, we're going to swap for a while. I'm going to give you $1,000 and you're going to give me your car for a month. And at the end of the month, you're going to get your car back and I'm going to get my $1,000 back. And in the meantime, you can do whatever you can, do what you need to do with $1,000 as long as I get it back. And that's the notion of how this kind of works. Is the Fed giving out loans the only thing they can do with the Fed? Okay, well, I'm going to substitute the word Fed IOUs going forward for cash. Yes, Fed, that's all they can do. Can they use it to buy stocks? No. Lend to other banks? No. Or lend to high risk? No. They can lend. All they can do is loan the money out. It's all to create new loans. So they can't use it to buy stocks, but someone can borrow the money to buy stocks. Can a high-risk investment fund borrow money to take more leverage? Yes, but it has to be, again, a loan from the bank. A loan is mostly mortgages. That's pretty common. That is one of the biggest loans in the market or in our economy are mortgages. Are there other significant credit categories? Yes. Credit cards, corporate bonds, correct. Car loans, yes. All those things. On Friday, when we go through the banking data, you see there's residential real estate, commercial industrial loans, and then consumer loans, which again, car, credit cards, and kind of other loans like that. So yes, that is what the banks can do with the money if there's demand and the banks wish to loan. But what if nobody wants or qualifies for loans anymore during a recession? There you go. They sit on the Fed cash forever, making QE completely ineffective. Yes, that's exactly why I say that easing is not easing until it eases. So the Fed putting money or doing quantitative easing doesn't work until people go out and borrow money and banks are willing to lend. You got it. That is great. I love it. Great thinking. I really like the thinking I'm seeing going on in these questions. It tells me not only that you're learning, but you're paying attention, and that's important too. So why does the Fed keep doing it if it doesn't work? Because the Fed has two tools. They can raise rates and lower rates. They can increase their balance sheet or decrease their balance sheet. So if the only solution in a debt-based economy to get people to borrow is to lower rates, so what are they going to do? They're going to push rates down until people borrow, and that's why we see rates fall during recessions. From my new friend and Boeing 747-8 pilot for UPS, if I was a pilot, I would want to fly the Queen of the Skies. I'm super jealous because obviously he flies packages and not people. Top 5 financial books of all time. I will get that for you, and you're not going to be impressed by the list. But one of my favorite books is Lords of Finance, and it's a history of central banking. Excellent book. I read it once a year, and it's coming up on my time to read it. But I really like to read things about how the systems work. How does a monetary system work? How does global trade cycles work? These aren't exciting reads, but I want to know how does the engine in my car work in terms of from an economic standpoint. But I will get that to you. I'll give you a list of that. All right, next question. If rates keep falling, while I eventually will be able to refinance my 30-year mortgage, maybe at 1%. I've been telling my clients that are like, oh, I need to go refi. I say, hey, hang tight. They're getting lower. They really? Oh, yeah, don't worry. They're going to go lower. It's at 3%, for example, which is pretty cheap money. Can you elaborate on how it affects mortgage rates? Right. When interest rates go down, 30-year interest rates go down, mortgage rates tend to follow. There's really not much more to that. Wow, I think if people could refinance their home mortgage of 1%, that would pump a lot of money in the economy. I hope it happens. Maybe. See, this is the beauty of really understanding the system. Okay, if I have a mortgage at say 3%, like this person here does, and I refi it at 1%, and I do not cash out any money. There's no new net money being created. The only thing being created is I might have more take-home. Well, I would have more take-home pay to spend. Now, if I am just spending that and I'm not using it to go out and borrow and create money, it's largely ineffective. Yeah, it creates a little bit of extra money, but it's not that big of a deal in the grand scheme of things. In fact, the lower rate I'm paying means my repayments to the loan are being destroyed even faster than they were at 3% going down to 1%. Now, if I cash out my equity in my house and I use that to maybe buy a pool and the person I buy the pool from doesn't have the money, so they, to build a pool, so they go to the bank and borrow money. Then you get some creation of money, but simply refining existing debt is no net creation of money. I hope it happens, he says. I think it, or she, I'm not sure. I'm quite sure interest rates are going lower, and so are mortgage rates. Also, can we use bonds like TLT, which is a Treasury ETF fund, as a gauge to find a market bottom? Great question. And the reason is because, remember, stocks, everyone loves stocks in green. That would be this way. I've got to get these right. They bottom, and then yields bottom right after. So stocks start going up and yields start going up, and TLT would be the inverse of yields. So to answer your question, okay, let's keep going on. Can I use this as a gauge to find market bottoms? In other words, is there an inverse relationship? Yes, there absolutely is. I was looking at the last recession. See, this is great because you're watching these videos and you're doing some research, you're thinking. You're not just turning on the TV and just listening to whatever the talking heads say. See, I don't even watch cable TV. I do not watch any financial network, period. I can't stand them. You think about how the system works. They don't tell you how it works. They tell you what they think, how they think, and then that's inaccurate. It seems like after the last TLT spike around 2008 December is also around the time the market bottom. Maybe there's a reason every week I'm so interested in talking about bonds, isn't it? Let's get on to some other questions that have come up this week in my mind, as people are all excited about gold. Gold, and I keep saying gold usually gets sold during recessions. It's sold for two reasons. One, because you get deflation and people cannot afford it. Number two, people need money, so they sell it. And number three, for the same reasons as number two, you see in recessions, people will sell their old jewelry and have it melted down. And so everyone thinks because the government's going to issue all this debt, that means gold goes up. All right. So I got a chart on the Federal Reserve database, which is free. And you can see federal debt, total public debt in blue. And you can see gold in red. And you can see there's no direct correlation. There are times they are, like right in here, but there's no direct correlation. So you can't say the federal government adding debt means gold prices go up. There's no basis for that statement. Now, if you really want to know what does matter, because everyone still thinks that when the government debt goes up, interest rates goes up. So again, we have federal debt in blue, 10-year Treasury yields in red, and what we're going to do is we're going to invert the federal debt. So like you can see, and we'll just go in and make a quick change to the formula, and voila, there you go. Even a little more impressive when you match it to 1980, and you can kind of zoom in and see that as federal debt increases, interest rates go down. Now, why would that happen? Because it's the federal government's ability to make any form of interest payment. So this is what people don't understand. As think about this. Let's say you had $22 trillion in debt, right? And you manage to have it all at 0%. And so you think, well, it's at zero, so I'll just take up to 30 trillion or some ridiculous number. Your tax revenues coming in aren't enough as it is to pay for the big expenses, Social Security, Medicare, and the military, let alone all the debt. So if interest rates go up at all, a small teeny bit, all of a sudden, now the deficit gets even bigger. So the government has to borrow more and more money. When they borrow money, they borrow it from the public. It's extremely deflationary. That is why when you see these stimulus, not really stimulative, package come out, and everyone's like, oh no, interest rates are going up. The government literally cannot afford it. And so the Federal Reserve drives interest rates down. That's why rates stay down. One of the things you want to see that causes interest rates go up, watch government, well, they won't do this, but if the federal government could and did run a surplus and pay down its debt, then interest rates would go up. But as long as they're deficit spending and taking on more and more and more debt, it is deflationary. Interest rates go down. All right, so let's roll into a few charts. I wasn't expecting this to be a terribly long video. Let's see, S&P 500. This is not normal going into the last 20 minutes of the market. Of course, the market's saying this has to do with Bernie Sanders. Maybe that's the case. Who knows what drives the moment-by-moment moves in the market. But I want to look at TLT. And let's go back to that comment of I was looking back at 2008, and I noticed that here's the peak of TLT. And let's overlay SPX. And here you see it. They virtually almost correspond with each other. Does it start to make some sense why I say I'll be buying what you're selling? Because when the retail public starts buying bonds, it's when I'm going to be selling, because it's when they're going to be selling their stocks to buy bonds. And now you're starting to see it. I prefer to look at this chart in terms of yields, but TLT is perfect. That's why I keep saying there's still, in my opinion, not that you should follow this as investment advice. You should not read the disclosure, listen to disclosure at the end, or read it in the below. Do not follow this as investment advice. It's my opinion, and why I'm so interested in the bond market, because the bond market will tell you almost when it's time to buy stocks. And so now you can see great thinking, whoever sent that question. I think great questions this week. I'm really seeing some great thinking going on, and it just really makes me feel good, and I'm happy to see that. So let's take a look at TLT now, and let's zoom in over the last 30 days and see what happened today. And I added this dotted purple line because this is kind of like the point of no return now. Why up here? Because this is the final place where we've seen some selling, and some selling. And today, I said this morning, I'd like to see TLT get up to 165 range at the top of this resistance zone, and it broke through. I was like, oh, this is cool. And all of a sudden, selling into the latter half of the trading day, and it got down, and let's just see what happened. And it's flirting right with the bottom of this resistance zone, and I'm not really concerned about that. And the only reason I'm not is because tomorrow we're going to get this massive jump in unemployment claims, and people that are unemployment do not borrow money at all. So what we see here is this was resistance over here. What is resistance? Where there's sellers. It's resisting, okay? It's like me standing in one position, you come up and pushing me, right? And I don't move, right? It's resistance. It's resisting. And now resistance can flip into support. And that is when I push back. So you come up and you're pushing me, and I don't budge. And so you go like, man, he's not moving. So I push you. And now you see the change here is starting to happen. And it's consolidating across here. But resistance is now starting to become support, because where are the buyers showing up? Just right down underneath here. So there's still some sellers, but we're starting to see buyers. Of course, we know who the biggest buyer is. That is the Federal Reserve, buying $125 billion, $75 billion of Treasury securities, $50 billion of mortgage-backed securities. And why did we see selling in here? Well, what did I tell you at the beginning of the video? What was happening today? Pension funds were rebalancing. What did they have to do? They had to sell bonds and buy stocks. Pretty cool. So what we've learned today is the Federal Reserve has absorbed a massive amount of that selling. Now, do I know for a fact there'll be even more big days like this? No, this may be the worst of it. This may be it. But all I know is the Fed is in charge, and they're going to drive prices higher because they need interest rates to go down with all this excess borrowing. And what I am interested, not we, because you are not following this as trading advice, but my clients who may be in this are looking for a break above this dotted purple line, sitting right here around 160, just below 167, because this is a big point of resistance. And after that, there's just really a lot of blue sky ahead. So very cool. When you understand the dynamics, the bond market tells you everything you need to know about where to be positioned with stocks and when to do that. So again, great questions. Hope those helped. And we'll be back Friday. We'll look at that banking data like we normally do and see what the markets bring us with our deeper weekly economic update. In the meantime, I'm Steve Van Metre. Thanks for taking the time to watch, and we'll see you then. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recognition or solicitation of buyer selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity, and the opinions expressed in this video that alone do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.